Thanks everyone for joining in today's call. We will be looking at FirstRand after having reported its first half-year results for 2025. Just an overview on the macro environment front, we expect the SA consumer to improve a bit further. We've been seeing this as banks started reporting lower impairments mostly, and also the first effect of lower inflation would have benefited the consumer, and then the lower interest rates as that also filters through to their side. On the results front, a couple of things there to highlight quickly is the net interest income growth was mainly driven by some loan growth. The non-interest revenue showed growth due to the net commission and fee income benefiting from both customer acquisition and the volume growth. Expenses was well managed with the profitability improving. And then on the UK FCA motor commission matter and that investigation, so there's no additional provision provided so far. They're looking at the court case that has to pass at the start of April. So after that there will be a bit more clarity, but for now there's a lot of uncertainty around that, but no additional provisions were made for the period. And another noteworthy thing is also the outlook improved, and that's mainly driven by there's still potential uptick in the in private equity realization and a good start for the year so far. Also the credit side, they also expect further improvement. On the non-interest revenue, apart from the private equity realizations, they expect similar growth to continue. However, on the net interest income, some pressure from the lower interest rate environment, they expect that to filter through. But overall, the guidance was initially for the full year to be the nominal GDP growth between that plus between 0 to 3% higher than that. Now they expect to be a nominal GDP growth plus 3% higher than that kind of range that they had previously. On the valuation front, if you look at multiples such as a PE, it's trading at the low end to its history if you look at a 5 or 10-year basis. We therefore think it's a good entry point with low valuations combined with a growth outlook, and therefore have a buy recommendation for FirstRand. So some things that we monitor when regarding FirstRand's investment case, so it does have higher and more stable profitability margins, such as a return on equity to most of its peers. So if the other peers would increase their margins or FirstRand decrease its margins on a relative basis, so that's something to keep in mind, because currently it does warrant a higher PE multiple because of that higher earnings quality. And then also if there's an increase in interest rates outlook, currently our outlook is more for still a lower interest rate environment, although with potential inflation risks at the moment and a bit more of a hawkish SARB, that's a bit to a lesser extent, but still the overall environment is still for lower interest rates. So we don't see necessarily interest rate increasing in the near term. And why we say that is also FirstRand manages each net interest margin or asset liability management. So they do manage the impact of interest rates. So that's why they are less impacted. So banks that manages this less in an increasing interest rate environment would benefit more. So that's why we prefer FirstRand also in the current environment of decreasing interest rates. It also has a bit higher SA exposure to some of its peers, so it's also dependent on the SA outlook overall.